Here to discuss that, Andres Garcia Amaya is the founder and CEO of Zoe Financial, and Nathan Sheets is chief economist at Citigroup. Great to have you both here. Nathan, let me just start with you. You recently made some changes to your GDP forecast, if I'm not mistaken. How do things look globally? Are we the only house in town at this point?
Our sense is that the United States continues to look pretty resilient. And we've maintained a call for a first half recession in the United States. Well, let me tell you, we're feeling increasingly anxious about that call as the economy continues to show momentum and the consumer looks pretty strong. But in contrast, when we look abroad, we're seeing a fair amount of weakness in two other major economies. And it's specifically in China, the consumer is looking very weak. After the reopening in early 2023, early this year, the consumer spent for a few months, but since then, confidence and spending has fallen off. And similarly, the Euro area, and specifically Germany, is looking very weak, because it was reinforced this morning with some of the PMI data, where it looks like manufacturing, which has been soft, is now starting to drag down services, which have been somewhat stronger. So a desynchronized global outlook is what we think we're seeing at the moment.
Yeah, not to go off on a Germany tangent, but, I read about the trains being way behind schedule and it's causing, and are they the new sick man of Europe? I mean, it's quite a change of fortune from the past 15 years. Andres, I'll ask you to just kind of go back to the broader investing implications, especially for the U.S. investor. What are they?
Yeah, so it's interesting because if you look at U.S. economy exposure to China, it is different to the S&P 500's exposure to China. Right. U.S. GDP exports account only for roughly 10% of GDP, but 30% of S&P 500 revenues come from abroad, and roughly 1/3 of those come from China. Right. So a slower Chinese consumer, a slower Chinese economy could actually have a outsized impact on the S&P 500 versus an outsized impact to the U.S. economy.
Yeah, and so if that's true for the S&P 500, Andres, what would your advice be to investors who are looking and saying, listen, if I'd missed the market this year, what do I do now?
Yeah, I would echo that we can't ignore the fact that the U.S. economy has been really resilient to a rising rate environment and to a slowing global economy. And I think that's one of the reasons we've seen the market act the way that it is, right? Double-digit returns this year. So you have to look at every factor here, not just, yes, China is slowing down, but on the upside, the U.S. economy has been very resilient. When it comes to the U.S. investor, I think the question now is, where is that incremental dollar going? Not just within stocks, but versus a bond or versus a savings account. And that's one of the areas that I feel a little bit more skeptical that we could go back to all-time highs in the stock market this year, considering now a savings account gives you more than 5% and a 10-year Treasury bond gives you more than 4%.
Yeah, I'm singing from your hymnal, Andres, so to speak. Nathan, I just want to mention as well, we had some significant revisions lately to the U.S. data. Yes, it's robust, but a little bit less so on the employment front, even prompting Mark Zandi, our friend and colleague, to say that the Fed, now that you look at the jobs data, we've gone from a pace of hiring about 300,000 jobs a month through March, less than 200,000 jobs a month since then, actually. He says it's strong but slowing, and this is the key part, and the rate hikes. You agree with that?
Yeah, I think that's broadly correct, that we're seeing the labor market moderate. The pace of job growth that we're seeing is much softer than, say, a year ago. But relative to pre-pandemic, still very, very solid readings. And I think the Fed is looking for more slack in the labor market and more evidence that its hikes are really getting traction on wages and services inflation. And quite frankly, I think that the resilience we're seeing is still not quite consistent with where the Fed ultimately wants to arrive.